This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hello, everyone. Welcome back to The Wealth Puzzle with Michael Mansfield, and I'm Tana Pennington. I know we made it. We're here.
We're back. We come and go. And go. Every time we do this, we're like, all right, that's it. We're back in action. We're going to do one every 2 days.
Yes.
Maybe that's what we do need. Maybe we have to go the opposite. Maybe we should make way too many videos way too often, and then we can wean ourselves off once we've kind of rebroken the bad habit of not hitting them every week. So in any case, welcome, Tana. Welcome, everybody. Appreciate all of our viewers, listeners. We appreciate the feedback we do get on the show and whatnot. So, hey, couple housekeeping things, just so that people kind of know, because I touch on this stuff on occasion, but for some reason it doesn't resonate. First and foremost, Connor, the tax guy, works independently of us. Now, outside of tax season, even though he's in our office, we use Connor for tax planning, where we pay him for his services and things like that. But during tax season, he's just the tax guy. We have no control, no understanding. I don't know where he's at on stuff. And so people always kind of confuse that, and they're always asking me, where's my taxes? I'm like, I don't know. That's not my department. So definitely gear all of your energy towards Connor if you have questions, concerns about that. Housekeeping number 2. I don't care for the people that have my cell phone number. If you want to text me to be friendly and shoot the breeze and make, send me funny jokes about Biden or something, I got no problem with that. If you guys want to check in and say, hey, what are you up to next week? Can we meet? All of that stuff's fine. But when it comes to really formal things, at this point, it is illegal to collect text. I don't collect text messages, so it's illegal for me to take formal requests via text. So all of a sudden lately, I'm getting a flood like, hey, I want to buy some stock. Hey, I want to sell. You can't text us that stuff. It has to come through the formal channel. Same thing with distributions. If you want money, don't text me on Saturday night. Hey, Mike, send me 10 grand because I'm sitting down here at the Players Club and I just lost all my money and I got to reload the machine to keep going. You need to send us a formal email that we can then record in the system and send over to Schwab. There's a process to things. So if it's a big formal request, call in to discuss it, or certainly send us an email. The texting is just becoming kind of a mess, because we're taking requests, but then begging people to email us. But now the people aren't emailing us the request, and then our records are all messy. And and I don't need the SEC to kick me in the chest next time they come in here when they find out that everyone's just a little too cash on the texting.
Yeah, that's a good point. Same with my direct line, my cell phone that everybody has. Make sure to email me when you want those requests submitted. Yeah.
Like I said, you can text us to shoot the breeze and say hello and check in and plan a meeting or something like that. But when it comes to real formal requests, we got to keep it formal, even though, like me, I'm wearing a suit. We're real formal here.
I don't see a suit.
That's offensive, because in my own mind, I wear a suit. And so how dare you tell me that I don't? Tana, do you got anything for us? Because I'm about to go down Rantville here.
Actually, just one quick thought. So Social Security COLA is expected at 3% now. It was at 2.4% for, a projection for 2025. But now it's gone up just a little bit, which obviously is an indicator that inflation is still,
going up.
Yep, going up.
Well, that's what I'm going to talk about today. Which is kind of a laughable thing, because really what that's saying is inflation's 3%. Like this year in January, when your Social Security went up 3%, 3.2, whatever it was, we're saying roughly last year, roughly inflation was 3%. Now, all of you should scratch I'm going to say hair as a joke. I'm going to scratch my hair. Maybe I scratched it too much. And that was the problem. I just kept like, what the hell? Nothing makes sense. And now it's all gone. I was driving around the other day and I'm listening to the radio. I always joke that I knew I got old when I started listening to AM radio more than FM. They're like, what a bummer. But in any case, the other day on the radio, they're saying, wow, in the beginning of 2020, if you spend $100 on groceries and then you fast forward today, that same $100 in groceries now costs $135.
Wow.
You're
That's
like,
a big
wow,
jump. Yeah.
just right there,
Yeah.
30-40% higher
Right.
inflation on those things. And here we have the government basically saying, it's 8%.
Yeah.
It's just negligible. It's crazy. So, I mean, obviously we can go down the rabbit hole, World War III, starting over the weekend. I mean, I don't know, poison. I mean, gosh, it's been a colorful year going all the way back to even the State of the Union a number of weeks ago. The things that are going on are just so all around us at the moment. So there's been a theme, and that theme has been the government. Honestly, between Powell, Janet Yellen, Biden, there's been this theme that we're getting a soft landing in the economy, that everything is going rosy, inflation is coming down. And what that's created is people are always asking, well, what is the driver? What makes the stock market go up, right? Those are a lot of the questions I'm really fielding from people is, what do you think? Is it going to go up or down? Well, we've talked about the three-legged stool. Have you ever tried to sit on a stool that has two legs, Hannah?
That'd be impossible.
Right.
Unless you maybe straddle it. I don't know.
Right. It would be difficult at best.
Yeah,
So the three-legged stool, what will keep the market up? What will prop the stock market up?
Yeah.
What will make the stock market go higher? It needs some legs. Do you know what the legs are, Tana? Gosh,
Yeah,
I hope so.
actually, yeah.
Well, what are they? Tell everybody real quick.
Company
Refresh your
earnings.
course. Good.
That's one. November election. We'll see what that does. And then also the Fed rates. They're gonna
that's right.
Keep flat or cut.
They're gonna do something. So there's your three-legged stool, right? So earnings are coming out. Earnings are fine so far, so that's harmless at best. We said based on earnings, if we're being unemotional, the S&P 500 should be at 5,200 this year. It's already there. The election historically is a euphoric charge for people. It has nothing to do with economics. Normally, people will drive the stock market up accidentally because they think their person's going to win. So they go waste money that they don't have and buy things because like, I'll go buy the new truck I can't afford because my person's going to win and it's going to be better for me. But then they already bought the car no matter what happens in November.
Emotional.
So election years are generally good years in the stock market, right? So we have those two things. And then the big one this year, the biggest driver, the biggest, fattest leg on the stool was the idea that the Feds were going to cut rates. And if you get in a time machine, you go back to December, there's Powell standing up there and he's talking and he's like, I love you all so much. I'm going to give you some inside baseball. We're going to do 3 rate cuts in 2024. Mm-hmm. We're going to take the Fed funds rate from 5.5 basically to 4.75. And I'm just telling you all this because I love you. And life is good. And we have a soft landing and inflation's under control and nothing's bad. And look at this, the labor market's tight. And so for the last 4 months, when we occasionally do these shows, Tana and I have been ranting about certain things. Like, for example, we did a whole show a month or 2 ago where we were talking about really the unemployment rate. And we were saying, hey, look at this. Last year, 2.8 million jobs were created, which is keeping the unemployment rate low, which sounds good, right? That sounds awesome. But then when you look under the hood, you realize that 60% of them were created by the government. Well, the government's broke. So that seems problematic when they're kind of propping up the labor market. And that's how a couple of our last job reports have gone. Is we've had strong job numbers, but once again, the majority of it's coming from the government making these things. Mm-hmm. And so those things are a little problematic. So what's going on with inflation? So let me pop up a little spreadsheet. I am bored, so I make spreadsheets. Where's my spreadsheet? This is my inflation spreadsheet. I'm going to zoom in, but you guys can see it on a bigger level. So what I do out of sheer boredom is I track. Let me just zoom in because I know it's hard to see. Let's go to 200. That looks good. So what I do is I track the monthly, like for example, if you're looking at this, like let's look at this first column. So like what was monthly inflation CPI for the month? So in August of 2022, it grew 0.12%. The lower bold number then is what is the total of the 12 months of monthly interest or inflation? What did it add up to be? And so you add up this 0.12 with all the previous months of whatever they were, and the number is 8.3. That's a big number for inflation, right? It's still really high back in 2022, if anyone can remember that. And so what you see here, kind of through my little spreadsheet I made, is in September it was 0.39, and all of a sudden inflation still at 8.3, and still 8.3. All of a sudden it's now 7.6. All of a sudden it's 7. All of a sudden it's 6. All of a sudden it's 6. All of a sudden it's 5. So what we have is this slow trend of inflation coming down. I mean, coming from 8.3% to 6%, it's still high, but that's a lot. And all of a sudden 4.8, 4.7. If I go more, we broke 4% in less than a year ago, June of 2023. Then I gotta slide my scale back over and start back over. Now I've got July of 23 the monthly came in at 0.21, and we're under 3%. So this is kind of where things start to get hinky. Remember, the Fed's been telling you inflation is going down meaningfully. It's going in the right direction. We feel really good. The trend is awesome. We're going to start cutting rates. We don't want to be too restrictive. We got our soft landing. Life is good. And so even to that point, when you followed when is the Fed going to cut rates, everybody was betting it was March. Well, what month is this, Tana? I can't remember anymore.
April.
Oh, it's April. Okay, there was no cut in March, right?
No.
There was no cut in April. They were then saying in March, oh, it'll be May. It's going to be May. May's the day. Well, guess what? It ain't happening in May at this point.
Probably
I'll
not June either.
Well, I'll get into that in a second. So when you follow inflation, I mean, going back to here, July of 23, so less than a year ago, 2.8, 3.3, 3.6. That's a weird trend over 3 months. 3.33. Okay. 3.1, 3.3. There's a problem here, and that is the annualized number isn't coming down anymore. Okay, so that's a problem in and of itself. But then there's micro math. Remember, this big bold number I'm talking about is a 12-month average. So we're still looking back a year ago and using last year's inflation and fast forwarding these numbers. But then there's a micro trend. And the micro trend is, what if you look at the monthly reads? What is the monthly read telling us? So for example, that's what this last row I did here. I went back 6 months real quick just to kind of look at the trend. So for example, in October inflation was pretty flat. It came in at 0.08%. So that's pretty flat. If you annualize that number, that would make if that number held true for a whole year, that would annualize inflation to be less than 1%. In the Fed's eyes, that's phenomenal news, right? Because we're trying to get this bad boy down a lot. In November, it was only 0.16%. If you annualize it, it's only 1.9%. In December, 0.2%. You annualize it, you're at 2.7%. But you see the trend here pretty much every month. Now it's at 3.7. Now we're at 5. So now we're kind of in the 4 to 5% range, the way monthly inflation. So for the last 6 months, monthly trends are trending back uphill. The down thing is over. We've been sitting in this flat zone for a while. Now it's just slowly starting to trend uphill. And the Feds are going, dang it, dang it. This is a problem. This is an absolute problem. Which is funny because if anybody follows the news, which I know a lot of people do, because I get all your crazy texts. So you're obviously all just sitting around watching the news with nothing better to do. Go do something outside, get some sun and some vitamin D, because watching the news is depressing. Let me be depressed for you. And, I'll sit here and watch it for you and be all upset. But it's funny because when you watch the news and you follow the data, like CNBC, man, they're like the tide. When the market's going up, everybody's on there like, market's going to go up forever. This is awesome. And all of a sudden the data has changed. And all of a sudden, all the headline talk, all the people they're bringing in, all the talking heads and whatever, all of a sudden it's changed. And now everybody's like, oh, all of a sudden that soft landing. Remember, the soft landing was intact. Now suddenly it's not. Here's an article. Jamie Dimon warns inflation and Fed policy is the major. Wait, what? I was told that this was all under control. Oh, so what do we do? What do we do, Tana? Tana's been paralyzed while I'm like, just, you think I had a bunch of caffeine? All right, so here's the chart. So if you've been in my office lately, I've probably showed you this chart, but that's okay. I'll show it to everyone else. This is a historical chart, right? This goes back 100 years or something, a little more than 100 years. So these mountains and little valleys and whatnot, this isn't historical inflation. So like we have this current blip of inflation and this valley on the far right of the screen. And then right in the middle of the screen are two mountains. So basically in the 70s, inflation picked up a lot. The Feds did what they did best. They raised rates a ton. They tried to get it under control. And so that hill suddenly rolled over and came down into this little valley right there, if you can see that on the screen.
Mm-hmm.
And then the Fed said, hot diggity dog, we've won the day. We can cut rates. This is, we're done. Well, they screwed up Fed policy, hence Jamie Dimon's point that Fed policy is the major risk the economy has at the moment. They screwed up policy, and what it led to was hyperinflation in the early 80s.
Mm.
And if you see, that's the highest peak we've had since current.
Mm-hmm.
And so it's tough because we're sitting in that same place right now where the Fed did a lot of work. They got inflation to roll back over, but now we're sitting at this inflection point. The inflection point is the Fed wants to cut. And the reason I say they want to cut is because they know that's the only way they get to keep their jobs in November. Because if they can cut now and they can make mortgage prices come down and car loans come down and speed up the velocity of money, it's going to create a soft little burst of economic activity that will make people feel like things are better. That will allow the current administration to run on that politically. And then everybody gets to keep their job in November because they say, whew, we did it. We saved the day. The problem is if the Fed cuts too quickly, they're going to reignite inflation and create hyperinflation like they did in the 80s. Mm-hmm. So we're sitting right on the edge of like, what the heck is going to happen? This is crazy. Now, the problem is you go back to the 80s, we didn't have a $35 trillion debt.
Yeah,
right?
That's a good point.
So the Fed is also walking a tightrope here because remember, the country is broke. We have all of our money out on credit cards. Those credit cards, it's almost like those weird balance transfers you do to try to move the interest rate around and all that kind of stuff.
Right.
This year, the Feds have to move something like $7 trillion around and refinance it. Well, if you go back and you were issuing bonds, a year ago, 2 years ago, 3 years ago, 5 years ago at 0.1% or 0.5%, you have to refinance that at 4 or 5%.
It's painful.
This country is about to have a going out of business sale when it comes to the interest on this debt. Yeah, you're right. It's totally painful, Tana. And so the Fed's in a really sticky situation because they want to cut. They know that that's pro short-term economics. That's pro getting reelected in November, keeping their jobs kind of stuff. They also know that if they cut too soon, they're going to create hyperinflation. Then again, if they keep rates the same or have to raise them to deal with inflation, then the interest on the debt is going to skyrocket. So the Fed's in a very weird pickle right now. And so obviously being the three-legged stool, now that the Fed's rate cuts are in question, that's why the market's been pouty for the last 2 weeks. All of a sudden things are rolling over. As usual, the stock market doesn't care about World War III. The stock market went down for 2 weeks when Russia invaded, and then it went straight back up to all-time highs. It didn't do anything when the Israel thing broke out at last October. Stock market doesn't care that much about those things. It cares about the Feds and what the heck the Fed's going to do. The stock market is absolutely drug addicted to that right now, is that cheap, easy money. So it's interesting. And the problem is we just keep doing things that are pro-inflationary. I mean, for example, I saw this pop up the other day. Biden just paid off another $7 billion of student loans. Now, I realize there's polarizing opinions about this stuff. Tana, you have a mortgage. Maybe that's a burden on you. I think the government should pay that off.
No.
You're kind of a victim, though.
I am not a victim.
I feel like you are.
No.
So what's amazing is so far President Biden has paid off $150 billion of student loans. The Supreme Court would probably say some of that was illegal, but that's okay. But this is a challenge because, like, you think about something like a microcosm like this as one example of inflation. The government doesn't have any money, so in order
Right.
to make money to pay these things off, we're stealing it from another program. We're printing the money. All of these things are inflationary. Then on top of it, take it down to the borrower level. That borrower that's supposed to be putting out that $300 a month towards their student loan to pay it off, they now have that $300, which
Yeah.
isn't necessarily a bad thing. But what it means is they can now redirect that towards other goods and services, which is only putting more supply side pressure on things, which ultimately will keep inflationary pressure in the economy because those extra dollars that we're supposed to be paying this stuff down, now we're going and competing for something else that somebody's selling or using. So, what is the point of this conversation? I don't know. Pretty crazy. So the market's rolling over. I'm secretly happy the stock market's rolling over a little bit. Here I've got the S&P 500 chart. So since last November, the stock market's gone straight up without taking much of a break. The stock market needs breaks. A healthy stock market goes up and goes down. And so to pull back from 5,200 down to 5,100, not the craziest pullback. It's not that big of a deal. This isn't exactly something I would get out of bed for. But at the moment, we have a little bit of breathing room. And so, it'll stabilize and keep going. Once again, the election is a driver of this. Earnings are a driver of this. So if earnings stay up, then the stock market is still in a very fairly valued range at the moment. The Feds will ultimately cut, right? That's the goal. If I was to put a political tone on it, if I haven't already, it might have been kind of political, but that's okay. To me, Mike Mansfield, this is Mike's opinion, is I view the very political line in the sand for the Feds as July. They need to cut by July. By cutting by July, that would make those rate cuts effectively hit the economy somewhere about 6 weeks before the election, giving just enough wiggle room to get some positive effect from it. So that's kind of where I would think that at the moment, it seems like the Feds could theoretically cut in July. At the same token, when bad inflation data came out last week, remember, nothing's political, right? Nothing at all. When inflation data came out bad last week, go Google this. President Biden came out and said, basically in a speech, don't worry, everybody, those rate cuts are coming this year. And I thought that's a shocking statement from a president because remember, the Federal Reserve and the executive branch are supposed to be two very separate, distinct, uncombined, uncoordinated, whatever entities. The Federal Reserve is supposed to be independent. So it's amazing that the president felt so strongly that he could say, hey, don't worry, wink, 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 wink. Those are coming, everybody. Anyways, this show has gone way too long. I spoke for 21 minutes out of the 22.
It was good information, though.
Was it?
Yeah, it was.
Anyways, if you have any questions, comments, concerns, feel free to email us. Feel free to reach out on our website. Obviously, call our office, 805-500-7035. Feel free to leave your rude, highly offended comments on YouTube as you do. We do all find those entertaining. So anyways, everyone have a great day, and we'll talk to you soon.